On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
Morning all, hope you're all well. Trust everyone is enjoying a nice relaxing Easter long weekend. I won't keep you for too long today. Let's run through some of the developments we saw across financial markets last week. Then let's turn our attention to what we need to keep an eye on in the week ahead. Right, it was another solid one for most share markets around the world. The S&P 500 in the US up 0.4%, the UK up 0.3%, European shares up 0.5%, emerging market equities up 0.4%, and it was just the Japanese market of the majors that bucked the trend and fell. Japanese shares were down 1.6%, but recall they did have a very strong rally the previous week. The Japanese market was up more than 5% the week before last, so I think we'll forgive them for seeing a little bit of weakness creep in. The ASX 200 across the Tasman up 1.6%, the local NZX 50 up 1.1%. So that was the March quarter wrapped up, the month of March and the March 2024 quarter, and it was a very good one for investors across the board. Most asset classes rose, most share markets were up, bond markets were up too. I won't dwell on any of the numbers or specifics because I am planning on recording an episode next week that will feature a bit of a quarterly wrap, what happened, who was up the most and why, what were the key events and developments that we saw, and then a look ahead to the second quarter in terms of what we can expect and what we need to be keeping an eye on. So we won't say any more about that, but rest assured your portfolio returns will look pretty good when you log into your KiwiSaver account or when you get your portfolio report from your wealth manager or fund manager. Interest rates, the US 10-year Treasury yield pretty much unchanged at 4.20. That's where it ended the week. The NZ 5-year swap rate down marginally. It finished the week at 4.3%, and the Kiwi dollar was down again against all major trading partners. And that's been a real feature of recent weeks and months, and certainly the first quarter. The weaker New Zealand dollar has boosted returns from Australian shares and international shares further. So on a trade weighted basis, the currency is down 3.1% since the beginning of the year. We're down against some currencies more than that, and we're actually up against a couple. The yen is the only major one we're up against, but it has had quite a big impact on returns. Against the US dollar, for example, we're down more than 5% year to date, and the Kiwi dollar sitting at just under 60 cents, which is something we haven't seen since about November last year. And when you consider the fact that the US market in US dollar terms is up a little more than 10% so far this year, you add in a 5% or so currency decline and your return jumps to about 16 odd percent. So it has been an important feature of what we've seen in recent weeks. If we look back to some of the key releases, the key one was the US inflation report, PCE inflation, as they call it, personal consumption expenditures. And this covered the month of February, and it's the Federal Reserve's preferred inflation measure. And this came out on Friday, which was interesting because obviously markets were closed for Good Friday, and it's quite unusual. I can't remember a time where we've seen an important report like the PCE inflation report come out on a public holiday. So we didn't get to see the usual market reaction. We will have to wait until Monday evening when the US markets reopen for that. But the PCE inflation report for February pretty much in line with expectations, which is good because it was closely watched after we saw another hotter than expected consumer price index inflation inflation report for the same period. So we didn't see any major surprises in these figures last week. Headline PCE inflation increased 0.3% for the month. That was actually marginally below forecasts, and core inflation rose 0.3% for the month as well. So on an annual basis, you've got the headline PCE inflation rate tracking at an increase of 2.5%. So that's up slightly from January. In January, it was 2.4, so it's ticked up slightly. 2.5, still generally going in the right direction, but just a little bit higher than we saw in January, although that was exactly as expected. And the annual core PCE inflation rate slipped to 2.8%. So that's down from 2.9. That's the lowest in almost 3 years. So both of those figures are trending lower. We're in the mid twos or the high twos. That's not terrible. We're getting towards that 2% target, certainly better than being in the threes, the fours, or the fives. Or higher, as we've seen in recent years, but it does feel like things have just got stuck a little bit in the mid to high twos. So they're not coming down as easily as we saw 6 or 12 months ago. If you look at the annualized 6 months average, which is something we've been watching closely as well to just get a feel for what the more recent trend has been, headline PCE inflation sitting at 2.4, the core measure sitting at 2.9. So not terribly different to what we saw last month or from what those annual figures look like. So that is important as we look ahead to the next few months in terms of what the Federal Reserve will do. And there is a speech from Fed Chair Jerome Powell coming up later this week that we'll talk about shortly too. So another piece of the puzzle there in terms of the US inflation backdrop and what the Fed might do next and when. On the local front, one of the key things I was watching for was the ANZ Business Outlook survey, and this covered the month of March. We saw confidence take a bit of a hit actually this month. Weaker activity, falling inflation pressures, but weaker activity, which is not out of line with what I'm seeing and hearing from all the businesses out there that I talk to. There's a definite tone of economic activity having slowed over the last couple of months, more markedly than we've seen in recent times. So headline confidence fell to 22.9. That's the lowest since September of last year. And after rising to the highest since the middle of 2021, own activity fell by the most in more than a year. It fell to 22.5. So construction saw the biggest decline in terms of the monthly fall. Manufacturing, agriculture, services all declined as well. The retail sector, interestingly, was the only one that improved. Now, I wouldn't take that as particularly encouraging for the retail sector at the moment. I think it's more a reflection of it having had such a difficult period in recent times that it's almost found a base, and so off that very low level, it hasn't taken much to see a slight improvement. So activity lower across the board. Pricing intentions, this is an important inflation indicator. That fell slightly to 45.1. That's the second lowest that we've seen in the last few years. Inflation expectations declined as well from 4.0 to 3.8. That's the first reading under 4 since 2021. And the proportion of firms that are expecting higher costs is still up there. It's still elevated, although the magnitude of the expected cost increases has been coming down, particularly in construction. So, as always, there's some good and some bad. The inflation indicator's starting to actually weaken. Still high, but starting to weaken as we would hope. But that is starting to come at the expense of economic activity. So that was interesting. Obviously, last week we also had the budget policy statement, which was the first from this government, and that is a precursor to what we'll see in May. The 30th of May is when we'll see the budget. The budget policy statement is sort of a high-level view of what they expect, what they intend to do, and a bit of an economic update as well. And in short, the economy is in worse shape than what we saw when we last heard from the Treasury and so forth back in December, I think it was. Economy's in worse shape. That is going to mean that the tax take will be lower, and that will mean that borrowing will have to be up, and we won't get a surplus as quickly as we were hoping for. We'll have to wait until May for more detail about exactly how the spending allowances will look. They didn't give us a lot of detail on that. And in terms of tax cuts, the government's still keen to give tax relief as they campaigned on. This is national at least, as they campaigned on late last year. But we'll have to wait until May for the exact form and magnitude of that tax relief. So more to come, but as expected, it isn't looking fantastic from an economic perspective. Right, looking ahead, we'll start with what we should watch here in New Zealand: dairy prices. It's actually a pretty quiet week, but we will have the results of the latest global dairy trade auction. They'll be out early on Wednesday, hoping for a bit of stability, because a fortnight ago we saw the headline GDT index down almost 3%. That was the second fall in a row, and it was the biggest fall since August last year. So most products saw lower prices, and that has seen the overall index fall back from where it was. It's still up slightly this year. It's still well above the August lows, but it's definitely come off the boil. Importantly, Fonterra did increase its milk price forecast in February, and then when it released its annual result a couple of weeks ago, it reaffirmed that midpoint. But it would be great to see prices a bit more stable. I guess the currency has been coming down, which is a positive when you think about that New Zealand dollar farm gate milk price. More going on internationally, particularly in the US. We've got a couple of really important economic releases, which will cover the month of March. We'll get the ISM indices, the Institute of Supply Management indices. So you get a manufacturing measure and you get a services measure. The manufacturing ISM will be due on Monday, and its services counterpart will follow on Wednesday. So I'm really looking forward to these. They've been okay lately, but the services sector has been much more solid, and the manufacturing ISM has actually been below break even for almost a year and a half. It's been 16 consecutive months, I think, that the manufacturing ISM has been below 50, and it quite possibly will be again. But what we did see with the flash PMIs for the same period a couple of weeks back is that the manufacturing sector looked a lot stronger. That was the indicator we saw there. So maybe we're in for a bit of improvement. US manufacturers did note that production was growing at the fastest rate since May 2022. So we're hopeful that the manufacturing sector has passed the worst and we'll start to see some improvement. So we'll get those two things on Monday and on Wednesday. Late in the week, the key economic release will be the US jobs report, and that will be out on Friday night, as it always is. This will be closely watched after the February release had something for everyone. Back then, we saw 275,000 new jobs created, but we also saw the gains from the previous 2 months revised lower, and we saw the unemployment rate jump surprisingly. It increased to 3.9. People were expecting it to be flat, and that's the highest unemployment rate we've seen since January 2022, so a little more than 2 years ago. Still low by historic standards, but the highest we've seen in more than 2 years. Inflation indicators were a little bit softer than expected, so that was good, but that went hand in hand with a slightly weaker labour market by some measures. So we'll be watching to see what happens in March. Markets are looking for 200,000 new jobs, so a little bit lower than we saw last month, but they are looking for that unemployment rate to come back a little bit to 3.8. And average hourly earnings, which is a key measure that people watch in terms of where wage growth is going, that's expected to have increased at a rate of 4.1% annually, and that would be the lowest since the middle of 2021. So that would be good news too. Those are the key releases that we'll see in the US and here in New Zealand. Like I said, it is a little bit of a quieter week. We will have some figures out of China, some activity indicators. We have got a manufacturing PMI coming out on Monday afternoon, then a services PMI coming out on Wednesday afternoon. Those are private sector measures, and they will follow the official PMIs, purchasing managers indices, that we see from the government on Sunday afternoon in China. I'm recording this on Sunday morning, so those are not out yet, but I will be watching those later this afternoon, so they will be relevant for what we see in the world's second biggest economy and in New Zealand's biggest trading partner. In Europe, we've got some inflation figures too. They'll be due for March, and the ECB, the European Central Bank, will release the minutes from its most recent meeting. So it's a holiday shortened week again in many places. In New Zealand, obviously, public holiday on Monday, so the markets will be closed. Likewise, Australia, likewise the UK, so it will be a bit quieter out there on Monday. The US is still open, so we'll still get the US market open on Monday. And another highlight of the week will be Federal Reserve Chair Jerome Powell giving a speech at Stanford on Wednesday. And that'll be interesting because expectations for a Fed rate cut are still pointing to June, although they have come back a little bit. They're sort of around that 65 to 70% level, which is a little lower than they were not so long ago. So markets are still hopeful we'll see a cut in June, but markets are also a little bit unsure. Powell did speak last week, I forget where he was, but he noted that the Fed has the ability to be careful about this upcoming decision because the labour market is still strong and the economy is still strong. So he's sort of saying, look, we don't need to be in a hurry to cut. And I think those comments did just impact expectations a little bit. So I think this more formal speech from Mr. Powell will be closely watched. And like I said, it's a quiet week here in New Zealand, but we have got that dairy auction. Building permits, the only other thing to watch here, although we are looking ahead to next week where there is a Reserve Bank of New Zealand decision, not a monetary policy statement, so an OCR decision, as they used to call them, and that will be interesting too, because here in New Zealand, markets are very firm in their thinking that August will be the time of the first OCR cut. So we'll be looking ahead to that next week too. All right, I told you it was going to be a little bit faster than usual, so much appreciated. Thanks for listening, and we'll talk again soon.